welcome back to The Income Generation. I'm David Scranton, your host. Each week we provide you with insights, thoughts, and financial remedies to give you greater perspective on many of the challenges you face. Those challenges, whether you're in or approaching retirement, and even more importantly, we present workable solutions. Today's show will focus on one of the greater challenges we all face in retirement, and that is the erosion of buying power. The timing is perfect because on today's show we have a Nobel laureate and have perhaps the most renowned name in the field of asset prices and inflation. If you haven't already guessed, I'm talking about economist Robert Shiller. I'm looking forward to going one-on-one with Shiller later in the show, as we both discuss the driving forces that affect prices. You know, every time the price you pay for something goes up, you can view it as the value of your money instead going down. Think about it. How much did you pay for your first house? Do you remember? Well, if you bought it in 1960, the median house price back then was $11,900. However, if you bought it 5 years later in 1965, you found the price to have grown to $20,000. That is a 68% increase in 5 years. During that time of generally low inflation, housing inflation averaged 10.94% over that 5-year period. One of the things we'll address today is that during that same period, the government's figures showed that inflation overall averaged only 1.3%. 10.94 versus 1.3, housing inflation was almost 10 times the general inflation rate during that 5-year period. Here's another example. In 1960, the average new car cost $2,600. Well, you'd have to cough up $9,400 for the average car 10 years later in 1970. That's a 261% increase. Now, during those same 10 years, the government's inflation numbers reported an average increase of just 1.8% per year. That's an enormous difference. Now, the basket of goods and services that the government uses to measure inflation will never exactly match what you and I are buying. But we all know that shelter and transportation are indeed big-ticket items on almost everyone's list. And almost all of us will have to buy another car at some point during the period in which we're retired. What's more, medical costs are also a budget item that most retirees simply cannot afford. And those are rising rapidly, much higher than the overall inflation rate. My point is simple. If your cost of living increases are tied to the government's measure of inflation, the CPI index, but your actual increased costs are based upon the real world, you may have trouble after just a few short years in retirement. And that is what today's show addresses. Here's something to think about. Earlier, were you able to remember what you paid for your first house? I bet it seemed like a lot of money at the time, but now think about what you paid for your last car. I'm willing to bet that the car cost much, much more than the first house. That is real-world inflation. In the real world, $1 would purchase 62% of a Big Mac burger back in 1986. The same dollar today will only buy 23% of a Big Mac burger. That's almost 1/3 of the food for your hard-earned dollars. That's what's happening in the real world rather than the government-controlled world of numbers. The average person hopes to be retired for at least 30 years, yet their buying power can be crippled during this time. It's possible that in the next 10 years, our dollar may only buy 75 cents or even 50 cents worth of goods or services. They also know they're going to need a good inflation hedge. So I'm glad you're with us today because ignoring this potential problem is the worst way to deal with it. Today, you're going to be learning what served as an inflation hedge and what doesn't. Most retirees know you have to earn enough interest or dividends to satisfy today's income needs. But the question becomes, how much extra do you need for inflation? And do you invest in things for growth for the future, or do you just try to earn enough extra interest and dividends so that you can satisfy inflation that way? The problem is that most assets simply are not good inflation hedges during periods of high inflation. So don't automatically assume that stocks, for example, are a better inflation hedge than bonds. In fact, in many periods throughout history, bonds have actually proven to be a better inflation hedge than stocks. We'll also talk about income from sources that may seem to be protected. Income from sources like Social Security or a pension with a cost of living benefit. I found in my own investment advisory practice that Social Security raises, when they do occur, are often eaten up by the rising cost of Medicare Part B. And cost of living increases are not ironclad or guaranteed in traditional defined benefit pension plans either. So the problem is simple. Even if you've invested so that some of your income sources more than allow for inflation, if you don't have an inflation hedge effectively on pensions or Social Security, then the burden on those investments is much, much higher than you can imagine. Why? Because not only do those investments have to provide an inflation hedge on themselves, but also on some of these other fixed income sources. The good news is today, we'll have answers for you. As I mentioned, today's guest, Robert Shiller, won a Nobel Prize in economics 2 years ago. He's a Sterling Professor of Economics at Yale, and he's most celebrated for his work which centers on asset pricing, including the effects of rational and irrational markets and intentional manipulation of demand and competition. You've no doubt heard of the Case-Shiller real estate indices, which were founded with Carl Case and Robert Shiller. They are the leading measure of U.S. residential real estate prices. They track changes in U.S. residential real estate on a regular basis. His work on pricing has gained the respect of many in his field, many who at first were a little bit less impressed with his unconventional theories. Well, his work related to asset prices and has over time become the standard of thought. I take personal pride in welcoming the first Nobel laureate to join me on the income generation. Then, during the second half of the show, I get to sit down with Marty Johnson. Together, we'll uncover solutions that you can use to help protect the buying power of your savings now and in retirement. This, of course, is a topic that will always be of high importance to you, the income generation.
The closing numbers on the markets today. At one point, the market fell as if down a well, over 700 points.
Apple shares are just getting hammered this morning.
We're down by between 3 and 4.5% generally across these markets. Let's talk about the speed with which we are watching this market deteriorate. We're red everywhere, essentially, down by 4-5%.
We're down over 16%.
Dow at the same time has fallen about 18%. The stock market is now down 21%.
Because we're now down 43%.
What in the world is happening on Wall Street?
Finally, there is an alternative. Read David J. Scranton's groundbreaking new book, Return on Principle, 7 Core Values to Help Protect Your Money in Good Times and Bad. Discover practical solutions to the financial challenges facing today's generation of retirees and near retirees. Learn the truth about Wall Street, the financial media, and the secrets they try to hide from everyday investors. This isn't just another book about investing. Working Americans who have lived through 2 major stock market crashes and the worst financial crisis since the Great Depression in the past 16 years don't need another book about investing. David Scranton's approach to financial planning is a holistic system designed for maximum protection, strategic growth, and reliable income regardless of market conditions. Stop planning for retirement with your fingers crossed. Plan with confidence, knowledge, and peace of mind. Read Return on Principle, 7 Core Values to Help Protect Your Money in Good Times and Bad. Available now.
So where are we right now with inflation in the United States? Well, if you follow what happened in December when the Federal Reserve finally raised short-term interest rates up from 0, you will know the current inflation rate is low. In fact, it's very low, just about 0.5%. And this is according to the latest government figures. In fact, that's one reason the Fed gave for not setting short-term interest rates higher right now. Low inflation is one sign that the economy may still be struggling. Fed Chairman Janet Yellen said she'd like to see inflation rise to at least 2% per year by the end of 2017. Personally, I have some doubts about that, which I'll talk about a little bit later in the show. Right now, though, I want to talk more about just how the government calculates inflation. Averages and percentages are important when it comes to setting economic policies, but they also can be very deceiving. They can also be manipulated. In fact, that's one of the reasons they often seem out of whack with reality. As consumers, we've all felt that way about the reported inflation rate for quite some time. And the older you get, the more out of whack it can seem. Retirees and people nearing retirement feel the effects of inflation more acutely than younger consumers. Many of you already know this, but that's due in part to the ever-increasing costs of medical care, which people over age 62 tend to consume at double the average for all consumers overall. As most people know, the Bureau of Labor Statistics measures inflation, as I said earlier, using the CPI index, what's called the Consumer Price Index. Since 1982, inflation for the United States, based upon the CPI, has risen by an average of 2.9% a year. But does that really seem accurate? We've already discussed the higher inflation rate in cars and homes during certain portions of this period. But think about this. Even a loaf of bread in 1982 cost 53 cents on average. Today, the average is $2.30. That's a 4.4% increase. The point is, as you pay for food and medicine, clothing, housing, and everything else you need each and every day, reality can feel way out of whack with the Labor Department's numbers. The effects of inflation can feel like they're eating into your income and your savings to the tune of a lot more than 2.9%. And if you take the time to do your own calculations, your numbers will probably even bear that out. Now, there are several reasons for this. I'd like to focus on one in particular because it's something a lot of people probably don't think about. As you're probably aware, the U.S. government is the country's biggest provider of the old-fashioned type pensions known as defined benefit pension plans. What's more, every January, the government provides people taking Social Security with a cost of living adjustment, or what's called COLA increase. The stated goal for Social Security is to ensure that the purchasing power of Social Security benefits is not eroded by inflation. The percentage of the COLA, the cost of living adjustment, each year, just like the increase on guaranteed COLAs and government pensions, is based upon that CPI. In other words, it's apparent to me that the government has an axe to grind when it comes to reporting the CPI. You see, if they publish a really, really high number, then all those pension and Social Security checks need to be increased by that amount of money. That would really add up over time as an added expense to a government that does already have record amounts of debt. So am I saying the government purposely fudges the inflation numbers in order to weasel out of its obligation to retirees? No. But I am saying that percentages and averages can be calculated and spun in a lot of different ways. As the saying goes, figures don't lie, but liars figure. And I'm saying the government does have what appears to be a motive for reporting an inflation rate that's on the low side. Actually, you could argue they have another motive for doing that. And this is called TIPS. These are Treasury Inflation Protected Securities. Like regular government bonds, TIPS pay interest twice a year based upon a fixed rate. But what makes them different and attractive to some investors is that their principal value adjusts up and down based upon the Consumer Price Index, the CPI. The payment you receive at the end is based upon this adjusted principal amount, as well as the payments of interest over time. The goal for this is to give investors who buy these TIPS an inflation hedge. In a way, though, this is like me loaning a friend a lot of money and letting him decide how much interest to pay back on top of the principal. Odds are he'd set a very low interest rate for himself. And when the government reports my bonds value has increased by 0.5% in accordance with their latest inflation figures, you could argue that that's a similar situation. The bottom line is that we all know when the government says the inflation is 2.9% over the past 3 decades or more, the reality may be that it's more like 5%. So when financial experts talk about the importance of having an inflation hedge in your retirement plan, obviously you need to take that seriously. A little later, Marty and I will be talking about what does and doesn't constitute a good inflation hedge for retirees today. In fact, there's a lot of confusion and debate about that, so we'll break down some of the options and see how they stack up. What's important to keep in mind overall, though, is this. If inflation has, realistically speaking, increased by 5% or so per year over the last 30 years, then you need to count on it increasing by at least that much over the next 30 years. As we've talked about on our last show, one of the major ways that retirement planning has changed over the years has to do with longevity rates, people living longer and longer. According to a major insurance company, been speaking with their actuaries, people retiring in their mid-60s have a 25 to 50% chance of living all the way into their 90s. Simply put, people today are living longer than ever before. And a 30-plus year retirement today is fairly common. What does that mean in terms of inflation? Well, when you do the math, it means that if inflation increases only at another 5% per year in the coming decades, after 30 years, you will need 4 times the amount of income you have the first year of retirement in the last year of retirement to maintain the same lifestyle. If inflation should increase a little to 7% per year, then you will need 8 times the income your last day of retirement compared to your first. So whatever your inflation hedge is, it needs to take into account these figures. If it doesn't, there's a chance inflation could erode your portfolio so badly that you can run out of income. What are the odds of that happening? Well, that depends on a lot of factors, of course. But a few years ago, a major mutual fund family came out with a tool based on something called Monte Carlo analysis. This is something that I and other financial advisors will often use with their clients. What it does, it calculates the probability that you'd be able to fund a 25 or 30 or even 35-year retirement without running out of income. The factors depend upon your stock-to-bond mix in your portfolio as well as your income needs. And it's all done through backtesting historical track records for stocks and bonds. For example, the 30-year chart shows that with a 40 to 60 mix of stock to bonds, 40 stocks, 60 bonds, which is generally considered to be really conservative, you actually have an 80% chance of not running out of money in that 30-year period when taking a 4% income stream per year. So if you have $1 million, that's $40,000 a year. Now, on the surface, that may sound pretty good, 80% chance of success. But keep in mind that it's also based on the government's official estimated inflation rate of about 3%. Bump that to 5 or 7, and obviously the odds go down. But perhaps even a more important point that I always make is this. Even if your odds of running out of income are relatively small, such as 20% in this example, would you be willing to take the risk considering how bad the consequences might be? In other words, it's not enough to ask, what are the odds it could happen? You also have to consider how bad would it be if it did. Would you find yourself financially wiped out in your late 80s? Think of it as Russian roulette. Even with just one bullet in a 6-round chamber, meaning you only had a 16% chance of shooting yourself, would you pull the trigger? Would you play that game? Of course you wouldn't. Why? Because the consequences if that 16% probability pans out are so severe. Keep in mind that at 20%, your odds of running out of money are even greater. So considering the magnitude of the consequences, the potential consequences, do you really want to play that game? Obviously, most people don't. Most people don't like taking risks that have a huge potential downside if they fail and offer a little reward if they succeeded. That's just common sense. Ultimately, wouldn't you rather have an inflation hedge and an overall strategy that gives you more like a 98 to 100% chance of not outliving your income rather than only 70 or 80%? Of course you would. So, stay tuned. If you're not using someone who's well-trained in fixed income and you're born before 1966, it may just be time for you to break up with that advisor and move on. I would suggest someone who will care for you through these important years of your life. If you need help finding someone, call or write us. I'd also like to remind you of the special report entitled The Income Generation. This is available free to you, our loyal viewers, online. If you haven't downloaded your report, pick it up after the show. If you're near or in retirement, head over to theincomegeneration.com and download your special report written specifically for the needs of the income generation. Again, those born before 1966. I'm David Scranton, and you've been watching The Income Generation. Today we'd like to welcome Robert Shiller, co-author of Fishing for Fools. His new book about Wall Street that the income generation will find particularly interesting. Professor Shiller, you don't really know about this, but I actually have a bone to pick with Yale. They were the only school I applied to when I was going to get my undergraduate degree who wouldn't give me a single penny of financial aid, and as a result, I couldn't go there. Now, I know you're not from that department, but if in later life, if I decided I wanted to go back to Yale for a graduate degree, do you think maybe you could pull some strings with the financial aid department for me?
Well, you know, I don't know when you applied, but the Yale portfolio, managed by David Swenson, has grown from less than $1 billion to in the mid-20 billions. That makes it easier for Yale to give financial aid. So I'll bet if you were young today and did it again, you'd get it. Yeah. Now, I'm just going to pretend for a minute that I didn't hear you call me not young, and we'll get on with the show. But today's show, of course, is about inflation, and I want to talk about your book just a little bit later. But today there's lots of rumblings about deflation versus inflation. Even on December 16th, Janet Yellen mentioned that although she raised rates by a quarter point, the reality was that she mentioned she's struggling to get inflation up to where she'd like it to be. Tell us about your thoughts looking forward. Well, Janet Yellen has been influential in the idea that the ideal inflation rate is not 0, but it's something like 2%. Mm-hmm. And part of the reason is that history shows that periods of deflation are economically weak. So let's stay a comfortable 2 percentage points away from deflation. Unfortunately, we're not there yet. She's trying. I don't think it's perfectly possible to control these things.
No, it isn't, but that's something I've wrestled with myself. I understand the theory behind 2% being a good inflation rate for a healthy economy, but I also know that for a good part of the history of our country, there was no inflation. But you believe, for the most part, that 2% is probably a pretty healthy number?
Well, I think this is really the influence of historical economics, behavioral economics. Yeah, I mean, it's better to have a little cushion. Maybe it's a kind of fish. Maybe it's kind of just, people get confused by 2% inflation and they maybe make mistakes. But on balance, it's a good thing. And we have to try to get there. I think Janet Yellen is right.
So tell us in your own words, our income generation viewers, of course, are always hearing from me in terms of my thoughts, but tell us in your own words why you believe she's had such a difficult time creating any inflation at all.
You know, to me, it mirrors exactly the reverse of the problem that Arthur Burns had as Fed chairman decades ago, that inflation just kept creeping up and he just didn't seem to have any ability to stop it. Mm-hmm. And he didn't understand, I think he admitted he didn't understand why that was happening. So, you know, the price dynamics is a complicated field. The low inflation now has something to do with our weak outlook and our sense of reduced optimism, things like that. And the Fed chairman can't control those accurately.
Yeah, and frankly, the raising of short-term interest rates, if anything, is not going to help create inflation because, in essence, we're just beginning to just a small extent, to tighten while the rest of the world is easing. So what do you think has to be done to try to create that 2% inflation rate?
Well, I think that rates are still low. That's the important thing. The economy, the unemployment rate is down to 4.9%. And historically, central banks would raise rates quite a bit in that situation. The small amount that they were raised is still leaving them low, and it should still work.
Now, Professor Shiller, your new book talks about the intentional and unintentional reasons behind the manipulations of Wall Street. And in that, you and I actually have a lot in common about our concerns. Talk to us from your standpoint about that.
Well, our book is not just about Wall Street. This is my book with George Akerlof. We think that there's a need to emphasize integrity in business, and that we need business organizations that uphold integrity, and we need government regulation. Akerlof and I love free markets, but we know that they can go awry, and I guess that's obvious, but it's not obvious in its entirety. So the financial crisis that we saw that really started in 2008, I don't think it was the result of mostly evil doers that doing crimes that could put people in jail. It was more people selling things a little bit too, not being completely forthcoming, maybe in the fine print forthcoming, but that's all. So we saw, mortgage securities oversold. People were oversold on the advantages of buying a home at the time. Mm-hmm. These are problems that catapulted us into a huge crisis. Not criminal problems generally, but problems that do challenge our integrity. And the next step has to be more and better integrity in business.
And of course, you can't legislate integrity. It seems like whenever you change the rules and the laws, then somebody finds a way around those rules and laws. So it has to come from a different source. And it seems like greed is a big part of it. Is there anything else beside corporate greed, would you say, that causes this phenomenon?
Well, I'm a scholar of behavioral economics. Right now, we talk about more than just greed. There's a whole array of psychological principles. But yeah, selfishness is part of the story. And I think that, if you go back to the 19th century, remember Horatio Alger? Mm-hmm. He wrote all these popular books for boys about success in business. But I went back and read one of them just out of interest. It was not just about if you try hard, you can be a success. It was about integrity. And it was about business people who hold back and do the right thing are much more likely in the long run to prevail.
Thank you so much for being on the show today. I very, very much appreciate it, as do all of our viewers. And I'm looking forward to getting that new financial aid package in the mail as soon as I get back up north. So with that in mind, stay with us. We have a commercial break, and we'll be right back.
Read David J. Scranton's groundbreaking new book, Return on Principle, 7 Core Values to Help Protect Your Money in Good Times and Bad. Discover practical solutions to the financial challenges facing today's generation of retirees and near retirees. David Scranton's approach to financial planning is a holistic system designed for maximum protection, strategic growth, and reliable income regardless of market conditions. Available now.
Very few people paid attention to a news event that happened during the very last days of 2015. I made note of it, though, and I even shared it with the advisors that I coach and mentor around the country that are part of our Advisors Academy network. And I mentioned how pertinent it is to future inflation expectations. What was it? On December 30th, Saudi Arabia said it will not change its oil production policy. meaning that even if there is a glut and oversupply of oil, they will not scale back. Many people didn't think about it, but the price of oil affects the price of everything sold that has to be transported and delivered. That is to say, if it's not a service, or it can't be delivered digitally by a computer, or you're not picking up yourself at a farm, the cost to get it to the store shelves is affected and compounded through every level of production and shipping because of oil prices. We've been talking a lot about inflation on the income generation, but the reality is today the cards are stacked against rising prices, and here's why. When economies are strong, demand is high. This might translate into higher profits for manufacturers, but in a weak economy like today's, competitive pressures force companies to pass the savings on to you. If you follow my show, you know that I think economic weakness will last for quite some time. And this is ironically the bright spot in our disappointing economy, especially for retirees, income generation members. That inflation may not be an issue for a long time. How long? Well, up until about 1930, it's important to understand that the United States really didn't have inflation. When we first started experiencing permanent rising prices, permanent inflation, was when the government got into permanent debt. This was during the Roosevelt administration. So inflation is actually a newer phenomenon here in the United States, at least permanent inflation is. And there's absolutely no reason to think that it should persist without fail every single year in the future. In fact, I liken our economy to that of Japan 10 years ago. We have a similar shifting in demographics. Over the last 4 years, they have experienced a low inflation average below 1%. In fact, in 2012, the annual inflation rate was below 0. The correct term for this is deflation. Over the last decade, Japan has experienced deflation 5 times. 50% of the time, they've experienced deflation. And although we're probably 10 years behind the Japanese economy or more, an economy which has been dormant for over 20 years, we might just have the right recipe for the same low inflation or deflation. Why? Because as baby booms peak, they drive business and growth because the new consumers begin to go through high consumption periods, which typically occur early in life. This drives economic activity. As the baby boomers, which cause the stimulus for a strong economy, retire and consume less, they effectively are no longer stimulating the economy. This happened in Japan as their average age increased. And the U.S., with its aging population, is headed in the same direction. We're just a decade or more behind. So the good news for the income generation is that they are in the right place. Just as they benefited more than most generations from the high-flying economy in the 80s and 90s and the stock market that correlated with it, in fact, in many ways, they caused it, they should also derive benefit from income-producing assets and payments, especially as the economy goes through a period of low inflation or deflation. You see, your buying power won't quickly be eroded by a fast-growing inflationary economy. That's why the period going forward could actually be looked at as rosy if you're in or approaching retirement. And in many respects, better than it would be if the economy were roaring. Again, because it would allow for stable or lower prices. And income-producing assets is where you should look if prices are going to drop. Think about it. The income you get will become worth even more. Your fixed income payments don't change on their own right, yet the payments will buy more and more over time. You're not likely to get that kind of benefit with stocks or real estate, which could be negatively affected by a shrinking economy. A lot of people have a difficult time comprehending no inflation or deflation with decreasing prices, and there's a reason for this. We have to remember the 1970s, and that's the experience for most of us when President Nixon took the United States off the gold standard, causing inflation to roar to 8.8% one year, 12% the next, and by 1980 we saw 14% inflation in that year. And that period is still part of our mental fabric. It's part of the paradigm which created our financial thinking. Just as many still expect the stock market to act as strong as it did in the 1990s, although in our hearts we know that's really not true. Neither is likely to reoccur based upon history, yet they become part of our paradigm, part of our experience. So in some ways, many have become to expect it. Again, historically, inflation is actually a recent phenomenon, with demographics being what they are in the United States. Wage pressures are low, so cost of production should remain low also. I mentioned earlier that transportation costs are down. Slow economy means less demand for commodities and raw materials used to make the goods. All the factors that generate inflation are well under control for the foreseeable future. In fact, the Fed, through its stimulus over the last 7 years, has been trying to generate and create inflation. They believe it benefits businesses. And let's face it, since the national debt has grown so much in recent years, if the U.S. got to pay this debt with cheaper dollars, it would make the job easier. I know this idea could be hard to wrap our brains around, so I'll describe it a different way. If you bought a home in the 1970s or 80s, the mortgage payment initially, I'm sure, seemed huge. But over time, inflation caused your income to increase, while your mortgage payments stayed the same. So your mortgage payments over time seemed to be smaller and smaller, and they were indeed a smaller percentage of your income. The same is true with the government. You see, inflation causes tax revenues to increase, having the same effect with the national debt as you had with that initially seeming large mortgage payment that ended up being less than a car payment by year 30. The problem, though, is that the Federal Reserve has failed to generate inflation. They had the recipe right. They flooded the market with cheap money to purchase essentially the same amount of goods and services. This all started, of course, 8 years ago, when the Fed brought rates to near zero and flooded the market with money. They threw in everything but the kitchen sink to right the economy and fight deflationary pressures. What happened? Well, currently our inflation rate is as low as 0.5%. Not very impressive if the goal is to create inflation. They simply could not make it happen. So if the extreme stimulus the Fed used with zero interest and $3.5 trillion in quantitative easing didn't raise inflation, then I suspect Janet Yellen could stand on her head and spit wooden nickels, and it still couldn't overcome the deflationary forces of an aging population. Baby boomers simply are not taking the low interest rate bait that the government has been providing. They've stopped making the big ticket purchases that they don't really need. They're reducing their monthly payments and saving more for the future, which is just considered sound personal finance. Now, you may still have some doubts about low inflation, especially if you haven't been following Japan over the last 20 years. History originally dubbed the period between 1991 and 2001 as Japan's lost decade. As time passed, the following decade came and went. Then the term changed to the lost 2 decades, and that term became popular. During this period, the Japanese stock market and the real estate market collapsed. The 15 years that followed this initial lost decade highlighted the reality of deflation. The economic collapse resulted in people accepting lower wages. Less pay led to a decrease in demand, which dropping demand caused even further decreasing prices and layoffs and so on and so forth as the cycle began. As people became accustomed to seeing prices drop, it also set their expectations that they'd continue to decline. The thought then becomes, well, why buy today when we can buy the same thing cheaper tomorrow? Waiting for lower prices lessened demand, which caused prices to spiral downward. That is known as the deflation spiral. Now, this may not sound like good news, and I believe the United States can avert the extreme levels of deflation Japan has experienced, but a little deflation could be good for you, the income generation. You know, we've learned a lot from watching the average age rise in Japan. One very important thing I've noticed is fixed rate assets do well when deflation is a threat. As investors become defensive and buy more bonds, high quality bonds tend to fare quite well, especially compared to stocks during periods of deflationary threats. This is why the traders and analysts at my firm, Sound Income Strategies, under my direction, look to add these opportunities to our clients' portfolios. I want to thank Professor Robert Shiller for being on my show. Please look for his new book entitled Fishing for Fools and learn how to avoid being fooled. I also appreciate the time Marty Johnson and I had discussing solutions and unknowns to a risk we all share, which is losing purchasing power due to inflation. Now, if you haven't signed up yet for our complimentary special report entitled The Income Generation, which allows readers to discover many answers to their investment questions, get it now at theincomegeneration.com. You'll discover a wealth of useful ideas you can put to work to better secure your financial security. And if you'd like, call us and let us know what else we can do for you. Get your questions answered and discover what other resources Sound Income Strategies can make available to you. That's all for today. I'm David Scranton. You've been watching The Income Generation, and we'll see you all again next week.